All right. Good morning, everybody. So we're going to get GDP numbers today. It's kind of a big deal. We're also getting a rate decision out of Europe. Markets are pretty much just holding the line, waiting on that, but we're seeing the S&P sell off a little bit. Still, I mean, just we're not going anywhere, right? We got to get the data. The VIX has given up quite a bit. If you read Spot Gamma's founder's note from last night, they mentioned how we didn't get the volatility crush after FOMC like we were anticipating. And it's very likely because of the GDP today, a little bit of the unemployment numbers too. And then we have data on Friday as well. So all that call buying in the VIX, they didn't let it go. They just went ahead and hung on to it. Kind of implies that there's still a lot of risk out there and a lot of concern about the numbers we're going to get. Small caps up 0.75%. The Dow basically flat. Japan right behind it. We're keeping an eye on the dollar this morning. So when we get this decision out of the ECB, out of Europe, really want to see what's going on with the dollar. The 2-year yesterday, I got the 10 here, but the 2-year yesterday during FOMC really got lit up. But we got the 10-year breaking down, trying to cut below that 4.5. It's kind of a big deal. That'll help a lot, but all eyes on the dollar. Let's see what we get out of that. We're holding above the volatility trigger, 0 gamma. We got the put wall a long ways off. 20-day moving average. We made contact with that briefly yesterday. 10-day moving average, the 3-week moving average. And then we have the 10-week down here at 60.11 cog line. As you can see, they've made plenty of room on the upside, 62.29 call wall. If you count the weeks, the next OPEX, February 21st, we're a long ways off. Plenty of time to get up to that call wall. So they've given themselves room. After today's data, or maybe even after this week, because we could just chop around here for the rest of the week, because we got Apple tonight too with earnings. Keep your eye on this put wall. We want to see it get rolled up higher than this pivot point right here, this 59, just call it 59.50. Nice, easy number. We want that put wall above that level. And we don't want the call wall rolled back down. So it's something that we're looking for, at least something that I'm looking for. The 0 gamma and the volatility trigger, kind of got to just let that shake out. For the average daily range, we got closer to the upper ADR than we did the lower, but we weren't able to take care of it before the market started positioning for the data this morning. The upper edge of the ADR lines up almost perfect with yesterday's high. So that's a double resistance point. Going to make it a lot harder to get through. Don't take that to mean that we can't get through there. When we get data, price will punch through any pivot point that's in its way. But if we get data that does not immediately drive us through that level, and then later today we try to get through 61.11, it's very likely going to be a hard trip, something hard to get through. So I'd expect at least one playable opportunity that we call first touch. And then if we get the breakout, we'll look for 111 and 1236. To the downside, to get to the lower ADR half, we'll have to get an inside day breakout. It won't put us on a breakout of the week, but it does match up really nice with Tuesday's low. It's not perfect, but it doesn't need to be. It's close enough. So that, again, is a double level supportive rather than resistance, but our ADR lines today line up with a high-low close from a higher time frame, so they've got more structure there. The top one lines up on the COG line too, so that's another reason to see it as a resistance point. We're developing a complex topping pattern without being back at the top, right? If we jump it out here onto the daily, and we'll just back up. When we were developing this topping pattern at this point, we're starting to form the same thing, only we're not back at the top, right? So if we go back into that other time frame, so we need to see how this plays out. Really want to keep this high, this low. We don't want a lower low. We want to continue to keep this higher low going that we've been putting in this week. And of course, we got this gap that needs to be resolved. We've had a hard time even just getting into that channel, let alone getting through it and getting that gap resolved. There's a bit of a push and some flows coming in. They're not hedging this morning. At least we're not seeing it yet. It's a little odd. Volume's at 61, which reinforces the idea that they're not in there hedging. Generally speaking, if they were hedging, we would see a lower volume, implying that they're sitting out, they're not trading it, and instead they're loading up in the options on a hedge. But at 61,000, they are participating and they are not hedging. All right, so we've been dealing with this weekly pivot point. We basically started the week underneath it. We got up to it. We've been struggling to get through it. Today may be the day where we finally get through it and get above it. And if we can close above it and keep it, it may be the start of the final push to get out of this range that we've been in. Otherwise, the daily pivot, which is much harder to see, we got to zoom in here a little bit. I know this is kind of frustrating. This is a very narrow channel. I've often said that when we're looking at these daily channels and we say, oh, it's kind of a narrow channel compared to these big wide ones. The channel can be so narrow that you don't even see a channel. All you see is a pink line. And if we zoom in this morning, that's how narrow this channel is, right? It's so narrow, we can't even see it unless we really zoom in. It's not even 1 point wide. It's not even 1 tick wide. So a narrow channel implies that if we do break out, it can grow legs and really run. When it's a really wide channel like this, it's more likely that if we try to break out, we'll fail and stall and we'll come back in again. Now these channels, they don't make price break out and they don't stop price from breaking out. They just give us some insight on what we should anticipate if price does get a breakout. So the breakout that we're talking about is yesterday's range. So that narrow channel implies that if we can run all the way up to yesterday's high and break out, we could really grow legs and run. Or if we get all the way to yesterday's low and break down, then we could grow legs and really run. But that's a long ways to go in either direction when we're nearly in the middle of yesterday's range. If we do get that breakout, we still get that 61.32 as a price target, a magnet, a line in the sand that we're going to be aiming for on the upside. And right now we're basically just digesting where most of the volume is this week. This is this week's point of control. And if we just kind of zoom in here a little bit, we can see this week's point of control, 60.78. Just, call it 60.80 for some easy numbers. This is where the most volume has taken place during this week's trading. So kind of want to stay above that level. We can wick below it as we did and get back above it. That's not really a big deal. But if we expand beyond it, above it, below it, and then we come back to it, we would expect it to act a bit as a resistance or a support. If we measure what we've got for the week, the halfback is 60.30 cog line or 60.32, and it matches up with the lower value area low on the week's profile. So another supportive structure. Ten-day, 30-minute volume profile, we still don't have a classic shape, and we're still expecting to wipe out this pattern as we move along, each new candle on the right taking out a candle on the left. Now we've got this shallow area from a really big push back here. This was January 15 and news that came in, gave us a real good push, but we didn't leave much volume behind. We'll go ahead and take that out, and that will narrow down the entire profile considerably. From there, we'll continue to wipe out this data. Now this low is set and it's close to us. So we're not going to narrow the lower end of this shape anytime soon. And the high is already set. That high and that low within a 24-hour period tells us that this is the range that we're going to keep, or it's going to get bigger from here. And that's not going to change anytime soon. Like when we've had those periods in time when it's been very narrow, say 40 or 60 points in a 10-day range. We're not going to get that anytime soon. It's going to stay wide. We still have a discrepancy between the green point of control and the blue point of control, TPO versus volume profile. We'd want more information about this low that was set, right? And whether or not we had a lot of volume at that level or a lot of trades at that level. And if we were to go back to this spot, will it act supportive or not? If we do manage to close this gap that we've been focused on this week, this 10-day point of control is right above that. 61.32. It's where the December FOMC began at 2 p.m. So that's a gap that needs filled, a liquidity gap. And then it's Friday's close, which is another pivot point or structure to be dealt with, which is why we need to get there to close the liquidity gap and the actual gap. No new VPOC from yesterday. And when we're looking at things from here over the last few days, you see how solid this range is, how we've been in hurry up and wait mode all week. Now, Monday was all about recovering from the big drop, the deep sink, all of that stuff. Tuesday, it was a focus on FOMC, and the idea was, we're just going sideways because we're waiting on FOMC. Then we get into Wednesday, and of course, we have to wait for half of Wednesday to get that FOMC. We're done with it, and yet here we are, still going sideways. There wasn't really any new information in FOMC yesterday. The market reacted at first to some language they took out of their initial statement. Without even asking questions, the market sold off because of one little sentence about normalizing and the goal to get to 2%. So it sold off on that. Then Powell went and cleaned that language up he was asked about it, and they said, well, we're just, trying to clean up our statement. We didn't mean anything by removing it. And so even that, which had been considered a negative, which is why we sold off, even that was taken out, and we ran back up to where we were before that behavior. So we're still on wait. Maybe it's the GDP today. Maybe it's the data tomorrow, or it's Europe. Whatever it is, we're still in hurry up and wait mode, and we've been here all week waiting on it. That run up that we got to start the week was only a move to try to get back to where we were from the deep sink. It wasn't because we were bullish in the market. So we're looking for this range to end. Now you can take that by, looking at yesterday's low and high or Tuesday's low and high. But I'd still argue that Monday is the boss. It's been the boss all week. It is still the boss now. Monday's low, Monday's mid, and Monday's high. We got to get out of this box. And it's not just the S&P that's in that box. If you look around, there's a lot of markets that are still stuck inside of Monday's candle. So we're still around 1% away from the 10-week. That's okay. It's a good start. We want that farther away. We want to get, around 2.25% away from the 10-week. Be a much healthier place to be. But being above it and being more than 1% away, it's good. If we get below 1%, it'll start to act a bit like gravity and start drawing us back into it. We don't want that. If we stay sideways for too long, that 10 is going to come up to us anyways, right? It's a correction in time rather than a correction in price. We're 0.25% above the 10-day. That's okay. I mean, we're above it, but we're close enough to it that we can still cross back and forth above and below the 10, and it won't act as a support or resistance, but instead more like a magnet and just crisscrossing it. We need to get away from it. So it's kind of what we're looking for here. Get out of that Monday candle, get away from the 10-day, close far enough away from the 10-week. Otherwise, if we go into the next week in the same position that we are now, then we're still correcting in time. We have been maintaining in the lower part of the weekly expected move after we got back inside of it. And we are IX10 inside of Monday's candle, but I would focus the IX10 on Tuesday. You know, we've talked about the idea that if you have an inside day and it's inside of a narrow day, then by the second inside day, which puts you into IX10, you've built up enough pressure that when you break out, you usually get a really good breakout. But it has to be a narrow candle range. So something like Monday, it's worthless. It's way too big to focus on for an IX10 breakout. Tuesday is narrower. Wednesday is even more narrow. So we are compressing here, winding up energy, building up energy for a move. I know energy may be a weird word to use, right? Because we usually use words like inertia, momentum, trend. But if you've worked with the RSI Laguerre, then really that energy word gets used a lot more. And one thing we learned using that indicator is that when a market goes sideways, it's building up energy. It's like charging a battery, putting gas in the car. So that when a market breaks out from that range, it's moving with energy behind it. When a market makes a move, it can make a move with energy behind it, or it can make a move to pick up energy. The analogy that I use for this is taking a ball out into the yard and throwing it. Well, you threw it, you put energy behind the ball, and that's what made it move. But as it travels, it loses energy, it falls, it hits the ground. Take a ball and drop it off a tall building. As it falls, it picks up speed. It picks up energy. So when something is moving, we want to know, is it moving with energy behind it? Which means it's going to slow down as it goes because it's building energy or it's losing energy? Or is it the other way around? Is it moving and gaining energy? Well, when we're in this IX10 pattern or going sideways, we're building energy up to make a move. Unfortunately, it doesn't give us direction, right? It doesn't point to higher or lower. Just that when we do make the move, it'll have some juice. The only thing we've got down this morning, of course, we had, FedEx and some earnings that knocked down transportation and VIX. Those are the only two that's down. This expanded tech IGV, a lot of times that won't move much in pre-market. So we can take a look at IGV, but that one and cloud were both off this morning when I was looking at it earlier. Yeah, IGV, depending on where you call the close, here's the 6 o'clock close or the 4 o'clock way up here, 103.5, and it's down 102.33. So IGV is down. Cloud had that really low print there, low algo print. It's already popped back up. Otherwise, it's mostly just the VIX. So we got the VIX down. We got pot stocks up the most. You don't want an S&P rally or a NASDAQ rally based on pot stocks. That's not what we want. Behind that, we've got gold and precious metals and silver, semiconductors, bonds, uranium and financials, and Bitcoin. We've got a really wide market breadth this morning, from utilities financials, precious metals. It's looking really good, but we got to keep it. And when it comes to a rally, communications, chips or semiconductors, technology, software, consumer discretionary, financials, those are the sectors we want to see that are up. If we have others with those, it's okay. We'll take everything we can get. But if we don't have those, it won't matter what else is up. Once we're done at 8:30 tomorrow, we'll be done with all the economic data for the week. So we'll have an open afternoon for opportunity. But throughout the day today, tomorrow's morning data is still going to weigh on us. So just kind of keep that in mind. One thing that I keep coming back to is they're not hedging this morning. So, we have to keep asking, are we sure that today's GDP is what the market is still sideways and waiting on? Because it certainly could be. But if that's where the concern is, where's the hedging? And if it's not today's GDP or even Europe's data, then that means it's tomorrow's data. And we'll see that hedging tomorrow morning when we come in. The next contract out is still positive too. It's got like a 60-point lead on us. So it's what I got for you guys. Watch the levels of yesterday, high and low, because they're double stacked. And keep your eye on the news. Pretty simple, all things considered. Be careful, be safe. I'll see y'all tomorrow.